Right, let's get started with the first conversation, which I mentioned is going to be on REITs, real estate investment trusts. What are they? How do they fit into your portfolio? What are the advantages that they have over buying traditional real estate? Joining me to talk about all of that and to give you the strategy that you can employ is Suresh Sadagopan, who is the founder of Ladder 7 Financial Advisories. Thank you so much, Suresh, for taking the time.
Thank you. Thanks for inviting me.
Suresh, I want to start with the most simple question, and there are a few people that are familiar with it, but so that everyone's on the same page, we'll start with what are REITs, what are real estate investment trusts, and how do they work?
Yeah. So we are all familiar with what is a mutual fund. I think by now, mutual fund is something that many of us are investing in, and we have a fair amount of experience in that. So as far as the mutual fund is concerned, it is a tool to invest in equity. So fractional investment in equity assets, debt assets, gold, all those things are possible. So even if you are a small investor, you could invest as low as say 5,000 rupees or even less than that. Some mutual funds are allowing even less than that. So you can invest that kind of money, and you can participate in a large number of companies in a particular category. So whether it is a large cap category or whether it is a sectoral fund or whatever it is, international fund. So you can participate in that category for as low as something like 5,000 rupees. So now, exactly on the same lines, as far as real estate is concerned, REITs are exactly the counterpart of mutual funds. So, I mean, as far as real estate investments are concerned, most people directly invest in real estate. Either it is land or it is residential property and sometimes commercial property. So you all understand, and I mean, you would have all invested at some point in time. So it's a very chunky, concentrated investment that we make in real estate. So it may be 50 lakhs, 1 crore, multiple crores. So that is how it is. So it is very difficult to for somebody to actually make that investment and realize the returns from real estate. And especially talking about commercial real estate, which is, I would say, the juiciest segment of the real estate market. The A category real estate, A-class properties are going to be leased by marquee clients and MNCs and big Indian companies. So they are looking for probably tens of thousands of square foot or maybe lakhs of square foot of property space. So if I have maybe a gala of 2,000, 3,000 square foot, that's not going to be picked up by a marquee company. And I'm not going to get the kind of rental that possibly a marquee company would be willing to pay. So it's a big ticket item and probably costing tens of crores of rupees, probably hundreds of crores of rupees. And REITs allow you to actually participate in these kind of marquee real estate, which we all want to invest in and we want to participate. So here is a fractional investment opportunity to invest in high quality real estate and get returns from the rentals, which you can get from these kind of properties. So REITs actually are trusts which invest in these kind of properties, A-grade properties across the country. And they normally do it through special purpose vehicles. So they invest in these properties through special purpose vehicles. And the properties underlying are managed by asset managers. Just like in the case of a mutual fund, you have a asset management company. Here also there are asset managers who will manage the property, ensure that the rentals are in place. They will also ensure that they renegotiate the rentals at the end of the term at an appropriate rental level. So all those things they'll be doing for a fee. So the good thing as far as REITs is concerned is that it is following the same structure as a mutual fund, which should give an investor like you all confidence. So you have a sponsor. Sponsor is somebody like the person who wants to, who is proposing to start this REIT. It may be for to give an example, it may be Embassy or Blackstone who will be the sponsor. And there will be a trust. The REIT itself is a trust, and there will be somebody like a trustee. In the case of Embassy, it is Axis trusteeship. So they are managing the activities of the sponsor and the and what is happening in the trust and asset management company. And then you have the asset management company itself, which is managing the property and ensuring everything goes with clockwise precision as far as the property is concerned. So that is the typical structure. So this structure is actually very good, and it it actually gives a lot of confidence in terms of ensuring that the REIT will work in your best interest. So as far as REITs are concerned, one more quick thing, Alex, I'll just share it with you, and then you can ask me further questions. As far as REITs are concerned, this is a place where you can get regular income. That is how it has been structured. So in the case of an REIT, 90% of whatever revenues they are going to get is supposed to be distributed. I mean, this is as per the mandate. They are supposed to distribute about 90% or more of the income that they are getting. And so for people who are looking for good quality properties, investing in good quality properties, getting a consistent rental income or consistent income from these properties, and they want to also have the liquidity which normally properties don't have. This is an ideal way of participating in that, because liquidity is given through the stock exchange. It is listed on the units are listed on the stock exchange. You can buy and sell units. So one of the things by which you can actually get a return is, of course, the income which comes from the REIT. The income typically comes in the form of a rental income if the REIT directly holds. Normally, REITs directly do not hold. It is coming through the special purpose vehicle. It comes in the form of dividend. It comes in the form of loan repayment, or it comes in the form of interest. So some of these incomes are tax-free, and some of these incomes are taxable. So what proportion of the income is taxable and tax-free, that will be disclosed by the REIT. And in accordance with that, you will have to pay the tax. So this is a very interesting new concept. This has, you can say, the features of a debt product, and it also has the features of an equity product. It has the features of a debt product in that here you get a consistent, reasonable level of income, like something like 7% or that kind of a thing. And underlying, since there are properties, and properties also increase in value over a period of time, so you also get potentially a capital appreciation over a period of time. So it has the qualities of an equity. Unlike in the case of a FD, which does not appreciate, here you have invested something, you get a regular income also, and at the same time, the underlying properties can also appreciate. So it's somewhere in between an equity and a debt-oriented product. So I'll leave it at that. I think we'll have further discussions. I would ask Alex to come in at this point.
No, absolutely. Suresh, you've hit several nails on the head in that you've laid out what REITs are. You mentioned that they are listed on the stock exchange. So you would essentially treat them like a stock, in that when you buy them, you're buying them like a stock, right? And then you subsequently get the income in the form of dividends that are given to you. So therefore, is the dividend distribution tax what comes into play?
So dividend distribution tax will come into play in most other cases. In the case of REIT, one of the biggest advantages is that the dividend which is declared by the REIT is not taxable in the hands of the investor. So the only exception to that is if that particular SPV is under a special dispensation which Government of India has come in. They are under some special tax dispensation, then of course it will be taxable. But REITs will ensure that they are not under that special dispensation. I'm not very sure about embassy, but in the case of Mindspace, they are not coming under that, and dividend definitely will not be taxable. Embassy, I'm not 100% sure. It's probably under a special dispensation. That is something that we will have to dig deep and find out. But in general, this particular advantage is there, where rental income, if it comes, or as far as dividends are concerned, it is not taxable. And in the case of interest income, that will be taxable, of course.
Okay. Now, I do want to understand a little bit more in terms of how this is going to work in somebody's portfolio, right? So the comparison that you would draw to this, Suresh, I would understand is you're either thinking of buying real estate as an investment, which is incidentally a conversation that we had in a very recent past, where we talked about the fact that a real estate asset is quite possibly one of the largest assets that you will ever acquire. It's a very substantial, chunky asset. So you would look at REITs as an alternative to an investment in real estate. Is that how you would look at it?
Definitely so, because in the case, a lot of people want to invest in real estate and it is a different asset class. So I'm also inclined to think that if you want to invest in real estate, this is probably the best possible way to invest in real estate. Because see, number one, you don't have to invest huge amount of money here. You can invest whatever amount of money you feel you want to invest in real estate. Let us say you have 10 lakh rupees or 5 lakh rupees or even less than that. You can invest only that amount of money into real estate and you can get the same advantage as another person who is investing 100 crores into that same property. You are a fractional owner, and to the extent of your fractional ownership, you are going to get a return exactly like a big property owner is going to get. And look at this wonderful thing. It is also, there is also no liquidity problems here. So in this case, at any given point in time, you can sell that on the stock exchange. The liquidity is there through the stock exchange and you can sell that on the stock exchange. So you have all the advantages of participating in a property. You don't have to have the hassles of managing the property, collecting the rents. You don't have any of the hassles. You are getting all the advantage of owning a property without actually getting into the hassles of managing a property. So this is, I think, the best of both worlds.
I want to understand the liquidity aspect of it. One would assume since it's listed on the stock exchange, there has to be a counterparty. So is there a risk involved if the REIT is not as well established? For example, that if the volume is much lower, then there is a counterparty risk. That's one thing. And also, if you have capital appreciation, like you said, that is one more way in which you can earn money. Therefore, in that sense, does it still follow the taxation in terms of capital gains?
Yeah. So the first thing is, of course, the counterparty. There has to be somebody who will buy over that those units. So that is, of course, there. These are very early days as far as REITs are concerned in India. So REIT market will develop. So, but I will go back one step before. REITs are not vehicles where you see great appreciation like in the case of stock. So you will see some appreciation for sure, and you will see also liquidity going from here over a period of time. So that is going to be there. So it's an evolving market, but for people who want really a diversified source away from, say, the debt products, and they want a source which can give consistent income, and it's from a different asset class. So from that point of view, this REIT is a great proposition. Okay, so one should look at it from the point of view of long-term setting up of an income, a consistent income. So from that point of view, this ticks the box. What was the second question, Alex?
The second, you pretty much answered that in that with regard to capital gains, I'm assuming that capital gains tax comes in, Suresh.
So as far as capital gains are concerned, you are absolutely right. If you are holding on to the units for a period of time, the capital gain will be there because of the property appreciation and because of the rental appreciation which happens over a period of time, because the asset management company will also renegotiate the rents. So for the same property, you are going to get a higher and higher rent. So one of the advantages in the case of an REIT is that you are going to, it is going to get adjusted for inflation, which normally does not happen in the case of a debt-oriented product. You get a certain level of return, whatever be the underlying inflation. So this rental yields always gets adjusted for inflation, and that's positive. Now, as far as capital gains are concerned, it is something on the same lines as equity, only that instead of 1 year, short-term is treated as 3 years, and you pay a 15% tax, and long-term is treated as beyond 36 months, and you pay 10%, just like in the case of just like in the case of equity-oriented taxation, only the duration is different in this case.
I want to understand in terms of strategy. Now, the one thing that you can say with regard to physical real estate assets, Suresh, is that when you look at it in terms of your overall portfolio, generally it will be warped completely. So you can't really look at it unless your portfolio is that big, right? But in terms of REITs, you can have an allocation. Like, for example, if you say gold should be about 10% and not more of your overall portfolio, and if you have a 60-30 sort of a ratio for the rest of it towards equity and then debt, where would you say that REITs can fit into it?
So let me talk about what generally we see as far as our clients are concerned, or general the Indian public is concerned, is that real estate as a proportion of their overall investment is actually pretty high. So it may not be necessarily commercial real estate, but it may be land and it may be residential real estate. So that's what we see in most of the people's portfolio. So, I mean, we'll have to look at the overall real estate allocation that people have in their portfolio, which in many cases is quite significant. So in the context of that, if we want to give an allocation in commercial real estate for all the for all the right reasons, probably, I mean, I believe we can look at it something like maybe 5 to 10% only. And in some cases, I may not be able to give any exposure at all, because a lot of people are loaded on real estate, and I may not want to give further real estate unless they are willing to sell off some existing real estate in favor of REITs. So it's a difficult thing for me to quote a number, but a 5 to 10% in commercial real estate through the medium of REITs, it seems to be a very good idea to start with.
Excellent. Suresh, I think we've covered all the bases here with regard to REITs. Thank you so much for taking the time.
My pleasure, Alex. Thank you so much for inviting me.